It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco. Good morning to you all on the West Coast, and 10:30 p.m. at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world. My name is Patrick L. Young, the IPO video live stream, episode 010, start here. From Supercycle Talks and all of the excitement of the world of technical analysis the other week with Murray Dunn, who was telling us the Elliott Wave wonderment, and indeed only 1 week to go, to see whether or not indeed their super prediction of a Trump victory will come through in the presidential elections. Today we have a change of pace, a change of understanding, and we're going to look at the wonders of the stock market once again. My guest this evening is Alasdair Haynes, an accomplished exchange executive, a very accomplished financial executive, and an entrepreneur in the exchange field. Alasdair runs Aquis Exchange. We're going to hear all about that in a moment. Alasdair, good evening. Where in the world are you today?
I'm sitting in France, so it is actually genuinely good evening. And to show I'm in France, I've brought a piece of the French economy with me.
What everybody needs at this time of COVID. Buy local, use something that's a product that can manage to keep the economy going. You're a fine Anglo-French patriot, Alasdair. So tell me, all about the origins of Aquis Exchange.
Well, look, I mean, Aquis I founded, I've been in the city for 43 years, and I founded Aquis 9 years ago. I'd run a company beforehand called Chi-X Europe, which I'm sure many people are familiar with. And I didn't quite know what to do once we'd sold the business to Bats, and wanted to be in the exchange business. And the absolutely truth is this was founded while I was buying my teenage son a phone in Vodafone in Tunbridge Wells. And in buying him, I think anybody who has teenage children will know the most important thing that any teenager has is a mobile phone. And I was buying Alexander his first phone. He wanted the all singing, all dancing latest iPhone with unlimited downloads, unlimited texts, unlimited calls. And I sort of worked out as a parent, a hopefully responsible parent, that actually wasn't the most sensible thing, because he'd probably be downloading stuff that his mother wouldn't appreciate, and he'd probably be chatting away to his mates and not doing any homework. So in the end, I bought him a £9.99 Samsung, and a very grumpy teenager sat in the car on the way home. And that was the epiphany moment, because I realized that what I'd been doing at Chi-X for the last few years was actually managing message traffic. And the only difference between a phone company, which is a utility, a demutualized utility, in the same way as a stock exchange is a utility and should be, managing message traffic. But the one difference was the model. And the model, obviously, of the phone companies is a subscription model. So I went back home, and I, being the person that I am, looked at a number of academic papers on subscriptions and was completely blown away. And I realized that this was a model that changes human behavior. It has the model that is used in the fastest growing companies in the last 15 years. If you look at the Fortune 500, and you look at companies like Amazon or Spotify or Netflix or cable television or mobile phones, it is in every other industry, but it's not in financial services. So we thought it was appropriate to bring a very transparent model to the financial services and introduce the marginal cost of zero. And that is exactly what we've done. And it was what our intention. And like all subscription models, it takes an extraordinarily long time to actually get to that point of sort of inflection, which really changes the business. But I think we're there now. And subscriptions do change human behavior. It's very clear. If you look at something like Amazon Prime, the people in Prime spend on average $1,000 a year. Those who don't use Prime spend around $500 a year. So human behavioral change is absolutely essential if you want to make change in an industry. And that's exactly what we want to do.
Absolutely fascinating, Alasdair. And I'm sure, ladies and gentlemen, if you've got questions for Alasdair this evening, drop them into the chat box via whichever particular device you're watching us on this evening, whether it's on Facebook, LinkedIn, or YouTube. So, Alasdair, you developed this model. Somehow or other, it seems to be a little bit perhaps alien to some of the people who may be out there in the world of exchanges. Did you encounter a lot of, well, user obliviousness, cynicism when you first came up with the idea?
Well, I've learned over the last, and as I said, 43 years in this business, of certain amount of cynicism. And actually, when somebody turns around, when I founded ITG Europe all those years ago, we brought in crossing, and I was told by many people that, this is a crazy thing, it's a US thing. Crossing, or dark pools as they're now known, was not something that should be popular. And it sort of amuses me that when I started that in the mid-90s, so 25 years later, we actually have caps on the amount of trading made by the regulators that takes place in dark pools. So yes, cynicism. People told me at Chi-X that, it was just a high-frequency trading business that would never be profitable, and the business became extremely profitable, very successful, and we became the largest exchange in Europe in terms of turnover. And I'm glad to say that people are very cynical about Aquis, and I think we're proving that model wrong. But it is back to that point about behavioral change. What you have to do is show that the status quo is not as good as what you can achieve if you're willing to make that change. So a lot of this is about data. It's about proving the point. And I think one of the things that makes us different at Aquis is not only do we have the subscription model where the marginal cost of zero, but we also introduced a rule that actually changes the type of liquidity within our market. And that's very, very important too. So what we have is a rule that was introduced that says proprietary trading firms can access the system, they can supply liquidity to the system, but they're not allowed to aggress. And we ask the proprietary trading firms to use a special order type called the post-only order type. So they can only ever post orders to our system. And that has changed because of the liquidity in the system. And that's changed it because of we've removed a type of trading that prevents the low latency arbitrage. And that's very important. And we're not anti high frequency trading at all. We actually think that it plays a very important part in the market. But we are differentiating ourselves as a marketplace that may be more suited to the longer term investor who doesn't want to see those immediate price movements that you might see caused in other exchanges. So the lack of toxicity alongside the subscription model has actually made us a very different liquidity pool. And today, we're one of the largest liquidity providers of any exchange in Europe. We actually control 21% of all the liquidity in the top 1,700 stocks in 14 different markets. So that makes us a major player in terms of liquidity provision. And we have around about a 5% market share of execution. So we believe we've got huge opportunity to grow as and when people see the data and start joining the market and using their smart order routers probably slightly more effectively than they're using them today.
Very interesting. So just to take it back a step, does everybody have exactly the same one-size-fits-all kind of model in terms of their subscription?
We're the same. We based the model based on the original phone that I bought Alexander all those years ago in Vodafone. And that basically is that you have a tier of the number of messages. So it starts off with a basic tier of £2,000 a month to trade 1,000 messages a day. And we count the messages. So we, unlike any other exchange in the world, we give you a daily record of the number of messages that you've used. And that's very important. And the way we count those messages is any aggressive message that is an order. It could be a cancellation of that order. It could be a change of price and a correction to that order. So it is far fairer than the way that exchanges operate today, because the cost of an exchange is actually the operation of its network. So the more you use the network, the more you should be charged. And the example I would give there is that if you trade one share of, Glaxo and one share of Vodafone, you tend to, because Glaxo share price is nearly 10 times the size of Vodafone's, you pay the London Stock Exchange 10 times more because it's on an ad valorem, on a percentage basis, which doesn't seem very logical because the cost of production for that order is exactly the same. The message either says GSK on it or VOD on it. So the great thing about the subscription model and charging by message traffic, as we were a telecoms company, means that our costs are far more aligned to the revenues. So the tier structure starts at £2,000 and goes right the way up to £80,000 a month for unlimited texts, unlimited text, like the mobile phone, unlimited trading, unlimited data, unlimited connectivity. And that's really important because that is where the true marginal cost of zero comes in. And our top clients today, get a much, much cheaper rate than any other exchange in the world.
That's fascinating altogether, Alasdair, and it's a totally, totally different way of looking at things, but logical given the fact that obviously it is a messaging-based unit. Plus also what's interesting, it strikes me, is one of the biggest problems for conventional exchanges has actually been managing messaging traffic. I mean, if you look at options exchanges, for example, where the difficulty because of the pricing model and all of the out-of-the-money option strikes ends up with the fact that they have to throttle the bandwidth because you can't actually get as many messages in order to manage to trade those markets. So it's quite fascinating because effectively you cap the use of the message at the same time as getting actually an appreciable income from every message.
Well, one thing for certain is you start getting more efficiency of messaging, and we've watched that with clients. I mean, very clearly, the most effective clients are the ones who use less messages in order to transact their business. But the marginal cost of zero is also very attractive because it means that once you reach that, you actually get to the stage where people will continue to give business because it costs nothing. And we've had that. We've had that experience. We had a customer who, eventually got to the top tier with us, and then actually called our trading desk and said, look, we've noticed we're at the top tier. Does that mean that every single time we trade, we should, it doesn't cost us anything? And we went, absolutely, of course. That's what we've been talking about for 4, 5, 6 years. And we said, well, surely we just adjust our smart order router that whenever you're the best price, we should be trading with you. And of course, absolutely you should. And if it's lower toxicity and it's a marginal cost of zero, and you have that depth of liquidity, which we do, then the things for best execution that apply to best execution are clearly here at Aquis. And that's why it takes time, because it is really, really important that we can prove to the industry with the data that this is the most effective, the best place for best execution. And I understand, because I've been on the other side. I've worked in the investment banking community, and people are often very skeptical. It takes time to change. But once you see that change and you see the benefits, that's when people move. And it's very common in the subscription model. The great example of that is Netflix and Blockbuster, who for years and years, Blockbuster laughed at what Netflix was doing. And today, of course, Blockbuster doesn't exist. And there you have Netflix continue to grow and in effect changing the movie industry. So we rather arrogantly put on the front page of every presentation that one day all trading will be like this, because maybe it is an arrogant statement, but it is very much what we believe, is one day all trading will be based on the subscription model. And that's really, important for the retail and the wholesale. I have this absolute belief that in the future, it doesn't matter what asset class you are, you will be able to get your smartphone and you will be able to trade any asset class around the world, and you will be paying literally pounds or dollars, a few a month, in order to be able to access and trade all these markets. That is how you enhance liquidity. That's how you enhance growth, and that's how you lower the cost of capital for companies.
Fascinating altogether. So it's very interesting, I think, the two numbers I've taken away so far. I mean, 21% of liquidity while you're getting 5% of execution. That would certainly suggest that you've got ample room to grow the percentage of execution in the near future to take something more than the 5%, which is a great number in terms of what's happening across Europe. And of course, you've been already proactive. So you started in London, but you've also got a European arm as well. So you're ready after Brexit.
Yeah, absolutely. We've opened an office up in Paris. We are regulated by the AMF and the ACPR, and we're using that. Now, none of us actually know what is going to happen with Brexit. And what we wanted to do is make quite certain that every single one of our customers is not, doesn't lose out by being able to trade with Aquis. And so we think we're pretty confident that we can trade anywhere for anybody, regardless of what the outcome. Now, I'm pretty convinced we're not going to see any equivalents, and I'm pretty convinced, having seen this week the ESMA's STO regarding European share trading, that we're going to see some form of STO in Europe, and possibly an STO, a share trading obligation from the UK as well. And I think the downside of that, of course, is we don't get hurt as an exchange, because what we see is split liquidity. But the downside is that very point. You're going to get bifurcated liquidity. And whilst there should be ample liquidity in each center to trade, you will see, I'm absolutely confident, wider prices because of the lower liquidity. I mean, that's just a function of markets. And of course, the loser there is the end investor, which ultimately is you and me through pension schemes or investment schemes or whatever. And that's not a good thing for the industry. And I'm hopeful that at some point in time, when the Brexit negotiations are finally concluded, that we will see some form of reconciliation for common sense to prevail over what seems to be going on now, which is political rather than actually commercial. As somebody said to me recently, the problem with common sense is it's not very common. So I think at the moment, we're not seeing any common sense, and not really by the politicians seeing an understanding of how market microstructure works. And in the end, it is damaging for the end investor. It's not damaging for the exchanges. We've had our sunk costs. We've paid for the office in Paris. We've paid for the regulation. We're there and we're ready to go. So that's a sunk cost for us. So it doesn't cost us any more to operate as it would do, in the past.
Quite interesting altogether. Yes, common sense could certainly do with the subscription model. Everybody seems to be on more bandwidth at the moment. They're only paying the $9.99 a month if you're lucky, I think, at this juncture, Alasdair. So you've got this fascinating platform. You've bifurcated it in terms of it's available via Paris and therefore to the EU27, and it's available from London to UK institutions of the world. Give us a flavour. What are your actual typical users looking like?
Well, look, today we started the business with aiming at the top investment banks and the top liquidity suppliers, because that's the logical place. You've got to start by winning the top groups, because they are the people who actually can control and move liquidity. And I'm pleased to say, out of the top 15 banks in European equity trading, 14 of them are subscribers to Aquis. And I think we have some of the world's leading liquidity suppliers as part of Aquis. And today we have 31 people, or the last results we have 31. It has actually increased a little bit since then. So 31 customers actually utilizing it. Now, I think the target there is something around about 90 to 100 customers in Europe. So it's not a retail subscription model. It is a wholesale subscription model. But the 90 customers, I think it's very, very hard for people to justify best execution. And this is important, that when the regulators start focusing more on best execution than they currently are, I think it's very important that the 60 odd people who aren't members of us today will look at the amount of liquidity, they'll look at the cheapness of connectivity, they'll look at the subscription model, and then we'll really be forced to join. So I am pretty confident that over the next few years, we will more than double the number of subscribers that we have today, and may even go further than that. And of course, the other lovely thing about the subscription model, when you're charging by message traffic, you don't really care what the message is about. I mean, when you talk and subscribe to Vodafone, they don't charge you a different amount for talking sport or talking to your family or talking to the office. It's just use of message traffic. So we can become the world's first exchange that is really, really agnostic to the asset class itself. We have every possibility to be able to, change asset class, enter the new asset classes. We don't care whether that message is a bond, a commodity, a currency, a derivative, or an equity. And of course, for us, our scope is the capability of being able to move to different asset classes.
Very interesting, the opportunity to move to different asset classes and be able to expand in that interesting way. And actually, we've got a quite fascinating question has just come in from a great friend of this program, Alex Wilkinson. Good evening, Alex. Lovely to hear from you once again. So Alex is asking, given the fact you did not allow the high-frequency traders to come in immediately and simply, steal the candy from all of the orders instantly, how much liquidity do you think that has been costing your early growth?
Great question, Alex. I'm not convinced that it cost us liquidity, but it certainly cost us the belief that people thought of the likelihood of execution. So in other words, people wouldn't necessarily transact on Aquis because they believed that the likelihood of execution would actually be lower. And remember, of course, that's one of the ingredients into what actually makes best execution, which is obviously price, depth, speed, cost, and then this likelihood of execution. And, where we cover on all four of them, we're pretty, we're definitely ahead of the other game. And it's this likelihood of execution that causes the problem. And the lack of sort of understanding, I think, at the early stages, which was the lack of data, did hold us back. Of course, what the market uses for likelihood of execution tends to be market share as a proxy. And one of the things I always say to people is that, when you look outside in the morning and decide on the weather, and you want to know whether you want to take an umbrella or whether you want to put on sunglasses, you don't look at the last 20-day weather reports. You actually look at the current market conditions and decide whether you should or should not take an umbrella and whether you get wet. And I would say the same problem sort of happens in our industry, is that you have smart order routers that tend to look at historic information rather than actually looking at today's information. And sort of, if you want to get wet, whether you want to trade is where the spread is narrow and the most liquidity is. But historically, what tends to happen on the SORs is that people look at historic information and they look at what market share you had. And market share, if it's small, as you are when you begin a business, you don't get that business. So you're absolutely right, is we missed out, and it's one of the reasons why it's taken us a long time. That said, of course, as our market share is now at 5%, or it was at 4.9, whatever it is last month, people can no longer turn around and say, I can't trade on Aquis, because actually our trading today on the lit book is greater than Turquoise, it's greater than the BATS book, it's greater than a number of our competitors out there. And therefore, if people are submitting orders to those platforms, actually, in truth, the likelihood of execution has to be a lot lower there, because if market share is their proxy, then actually they should be putting their orders with us. And this all goes back to how much education we have to do as a new business in the way that we have to change back to changing human behavior. And I think more, it's common sense. And at the end of the day, we will win that argument.
So common sense is something that's at a premium, and smart order routers really aren't very intelligent. That's one of the second messages that I'm hearing from this at the moment. Maybe what we need is, with smart order routers looking at sort of historical activity, maybe we need implied order routers rather like options between historic volatility and implied volatility to move forward.
Well, I wouldn't say all smart order routers are dumb order routers, but some are certainly more dumb than others. And I think this is where there really is going to be a change, and you can see that change taking place. Banks no longer have what used to happen if you go back 20 years, a head of trading who made the decision about best execution. Banks today have best execution committees, and in those committees, they have a lot of people who are academics, research, analysts, as well as operational, legal, etc. Now, of course, that slows the process down for getting best execution approval, but it's actually made best execution a much more effective product and more important product. And I think this becomes more and more important because the regulators will undoubtedly start to look closely at whether best execution is being achieved. And, again, it might sound an arrogant statement, and I don't mean it to come across that way. But, in truth, best execution has been pretty poor in our industry. I used to say a number of years ago, it was always try my best execution rather than actually best execution here. And, as people have data thrown at them, it's going to become harder and harder for both them and the regulators who will be able to look at this data to not access great liquidity pools such as us.
Now, Alex, you're on a roll this evening. Thank you very much, Alasdair, because your answers are throwing up further and more interesting questions. Okay. Applauding you for a great answer. I totally wholeheartedly agree with that. Excellent answers so far, Alasdair. So, talking about the education, the issue of managing to get the market up to scratch and therefore get them habituated to your venue. But then Alex comes in with a bit of a killer question. I'm far too polite to ask that, certainly at 25 hours. How long do you last as an independent in that case?
Well, Alex will know very well that one of the great things of being a public company is, of course, I can't actually answer that question. Because I can't actually sort of turn around and say whether people will think or whether we would or would not get an approach. But let me make one thing absolutely clear. I absolutely believe that this company has got a long, great future in front of it. I absolutely am not the person who wants to turn around and sell this thing or flip it or whatever. And I want to stay independent because I believe that there is a lot of things that we can do out here to make this the great company that it deserves to be. And, it's one of the things that's really I'm passionate about. I've reached 60 now. I have no intention of retiring in the next few years. And I want to be able to see this thing grow to what it should achieve. But, I can't really answer as to whether we be independent. What I can answer is to say I want to be independent.
It's a very, very interesting answer, Alasdair. And therefore, concentrating on the present so that you don't do anything that you can possibly say wrong as a public company steward, just give us a quick heads up. You have been listed for how long and where, and give us an idea of your kind of shareholder makeup.
We've been listed for 2 years, just over 2 years. It was June 2018. We're listed on the AIM market. Obviously, you know that we bought the NEX Exchange, and therefore we're highly likely to dual list on our own exchange. So that's information that we certainly we're looking to do. We can't say we're going to do it yet. We need to get some regulatory approval in order, but we certainly want to do that. We went to market deliberately quite early. We weren't profitable at that stage. Our last set of results, you'll have seen we have now achieved profitability. But the reason we did it was actually for the best marketing exercise you'll ever have. And that's probably summed up by the very first asset manager I saw on the roadshow. And what I did is we did the presentation. We showed him the slides about toxicity. We showed that, the difference between us and the end investor, so us and the national exchanges. If people were to trade on us and not the national exchanges, the difference on the minimum tick size because of toxicity would be in more than £1 billion a year. That's 1 week's pension for every private pensioner in the United Kingdom. It's a substantial sum of money that we can save because of this lack of toxicity. And at the end of the conversation, the fund manager turned around to me and said, "Alasdair, look, it's a fascinating story. I think you're way too early. Why don't you come back when you're profitable? Because I think you'll be a much higher market cap and you won't necessarily be on the AIM market." And I actually said to him, I said, "Look, have you ever heard of Aquis before this meeting?" And he went, "To be perfectly honest, no, I've never heard of you." I said, "What are you going to do when I leave this meeting?" He said, "Well, I'm going to go and check with my traders to make absolutely certain that my stock, and when I'm trading, actually does point towards Aquis." And I went, "Exactly. And on this roadshow, I'm going to meet 40 asset managers." And he then said, "Right," you can see the light turn on in his eye. He said, "Right, I've got it. I've absolutely got it." And they invested. And they, alongside a whole load of others, and our investors are people like River and Mercantile, Schroders, AXA, Killick, Rathbones. And we've got absolutely blue chip companies behind us. And I think that's really important because I think it showed the industry that the asset manager likes this model and they support this model and they support the things that we're doing.
And I think that's a great point, actually, you brought up. I mean, the whole idea of being able to get out on a roadshow so that buy-side fund managers actually know you exist. Because, of course, as you remember only too well from your lengthy experience at ITG, and indeed I remember from being a director of LiquidNet in Europe, one of the problems with institutional grade equity matching platforms is that often the fund managers have never heard of you. So therefore,
correct. And that's absolutely important. I mean, our sale is not just to the traders within the asset manager community. It's not just to the banks, it's also to the fund managers. We want people to know what we're doing. We are probably the most radical thing to happen to the equities market for a very, very long time. I mean, this is a very, very disruptive model. I can tell you that about 3 or 4 Christmases ago, I was at a drinks party with a number of CEOs of national exchanges around the world, and somebody I knew pretty well, I won't say who it was, but they came up to me and said, "Alasdair, we're watching you like a hawk. We really, really want you to fail." And I think that said an awful lot to me because, I think it is. People are looking at what we're doing. They don't necessarily want us to succeed because we are going to change the way that the movie industry in Hollywood is no longer the incumbent maker of movies in the world. In no way was Blockbuster the provider of videos. You get Netflix, or no way does the telecom companies, operate in the way that they used to. There's been massive change in each of these industries for the benefit of the end user. And that is the one thing that we keep on having to remember here. Why do we do this? We do this to create greater liquidity, more opportunity, which is ultimately brings the cost of capital down. And that is really what this is about. Is you get better liquidity in secondary trading of large caps and small caps, then the cost of capital falls. And what we see is as a result of that, is the stop of this de-equitization that's taking place and companies being sold privately, and more companies coming to the stock market, more companies coming, but people can invest, the retail and wholesale can invest and get better returns. And that's good for in pension funds, it's good for insurance companies, and it's good for the companies that issue. And that's why this is so important. We need to make these changes in order to get a more effective marketplace than we have today.
And just give us again, you've rattled through so many numbers, that billion number you just gave us in terms of savings. Say that for us slowly once again, please.
Okay, the difference in the toxicity, I wish I could show you the chart, and anybody who wants to, who's listening to this program or watching this program, more than happy can write to me and I can send them this data. It's a freely available data from many different providers. But what we can show you is that if you look at every single trade that transacts on Aquis, and you look at the price movement after that trade, in milliseconds. So we're looking here in fractions of seconds. This is not transaction cost analysis. You can see that every other exchange, the price moves away faster, quicker, and more than it does on the Aquis exchange. And if you look at that difference, and that is assuming the price moves one tick, and many of you will know that within MiFID there are tick tables. So what happens is that a stock has to have a minimum spread. And so if it moves more than one tick, which is likely, but I'm assuming it's only one tick away, so that's the best case scenario, the difference between trading on us and actually trading on another exchange is worth £1 billion a year. Wow. That is a substantial amount of money. And what we're doing is, because we've got this model, because we have these rules in place, we can not only save banks, and we think we can save banks, if they used us properly, somewhere in the region of 15 to 20 million pounds a year, just purely on exchange fees, but we can save the end investor £1 billion. Now, that really is important, because what it does is previous people who have attempted to compete with exchanges have tended to save their customer money, but not necessarily their customer's customer. And what we've made a point here with our model, which is why it's the combination of the subscription model and the rule that makes us different, is we save both. We save the customer, which is the bank, and we enhance the performance of the customer's customer, which is the asset manager. And if you can do both, then we are a real threat to the current way of trading on an exchange.
Alasdair, it's absolutely fascinating altogether. Thank you very, very much once again, Alex Wilkinson. Great questions. Always a joy to have you joining the show. Thank you for adding today, and indeed excellent answers. I would wholeheartedly agree, coming from our guest, Alasdair Haynes. Now, ladies and gentlemen, if you want to learn more about the world of exchanges and what happens in them day to day, don't forget to check out my newsletter, Exchange Invest. It's the business of horses, the only subscriber product that's available, coming to your inbox every day, explaining what happens in the business of the stock exchanges, the commodity exchanges, and all the rest of the financial market infrastructure the world over, read by illustrious executives in the exchange industry, such as indeed our guest this evening, Alasdair Haynes. Now, Alasdair, you mentioned it earlier, fleetingly. You said you listed on AIM, but at the same time, you bought yourselves an exchange just last year. So tell us a little bit about NEX Exchange and your plans for that.
Well, look, we bought NEX, and one of the things I always tell people is, fifth time lucky, it's not an easy sell. We bought NEX, we paid £1. The business, I think, cannot be described as having been a success. I think its predecessor, whether it was called ISDX or whether it was called Plus Markets or OFX, they've never really been able to compete properly with any growth market in Europe. And what we're looking to do here is we bought this as a license. It has the recognized investment exchange license, and we want to use our experience in the equities business and our knowledge with technology to be able to change it. And there are three things that we have to do in order to make this a success. And the first thing is, we've got to convince asset managers that this is a marketplace with stocks there that they ought to invest in and they should invest in. In other words, an asset manager should have they should be completely agnostic as to where something is quoted, rather than just, I will only trade on the London Stock Exchange or on AIM. And we're doing that. We've worked, because of our investor base, we worked very closely with them, and we will shortly be putting on our website a list of asset managers who are totally and very happy prepared to invest in companies that are quoted and decide to go public on the Aquis Stock Exchange growth market. And that's really important, because we can prove to the industry that there are people who they can raise capital. That is obviously provided that the company is a good company and that it has good corporate governance and it's suitable for the portfolio. The second thing we have to do is we have to make certain that we have a standard that is higher than the current standard even on AIM. And the way we're going to do that is segregate the market. And if you think about it, great companies start small, they grow, and they mature. And exchanges today tend to have no ability to be able to transfer stocks from one market to another place. And therefore, the proportionality of regulation and the proportionality for the mechanism of trading isn't correct, because it's one thing for all. And that's not right, because a company with a market cap of 5 million trades and should have different regulatory requirements to that of 100 million, which again should trade and have different requirements for that of, say, something that's 5 billion. So what we've done is we've created a segmented market that has access, which has a different regulatory requirement, needs an admissions document, market cap less than 10 million, all these different things. And then we then have the second market, which is, or the next market up, which is the apex market for larger growth companies. And again, that segment will require a growth prospectus. And why do we want a growth prospectus? Not just because it's higher standard than an admissions document, but it allows retail into the IPO. Now, if you want liquidity, you have to have retail. So many people, and myself included, make the mistake when they go public by not having retail play. And what you do is you get a series of investors who like your stock, hold it, and then you have no liquidity. And many investors today require a liquidity level which these companies can't sustain, and therefore they don't find the investment. So finding retail, which acts like the oil within the wheels of the system, in order to get this, to be able to get your liquidity higher, is really, really important. And then the third thing is we've got to have liquidity. Many people complain, and you can't get liquidity. If your stock is £1 million and you've only got 10% free float, you can't expect it to be incredibly liquid. But you need a mechanism, like an auction mechanism, to allow people to trade when they feel they need to trade. Similarly, you need to get competing market makers in the different category. So in the access segment, we're going to have market makers, but we're going to have auctions. In the apex segment, we're going to end up with a competing market maker scheme. And you will read in the next few weeks a detailed scheme that I think we can cap spreads for retail players. I think we can have larger liquidity, and we can have electronic access for people to be able to come in and trade. That is fundamentally different to what you get on any other growth market today. And I sort of get very, very irritated, because we have the same advantages as a growth market. No stamp duty to pay on our shares. There's inheritance tax relief, IHT relief, VCT, all these different benefits that we get. And great, so you save stamp duty, but if your spread is 15 or 20% wide, what's the point? Because we're focusing on the wrong thing. We want those spreads to be narrower, we need the market makers to compete, and we need to enhance the liquidity. Now, if we do all those three things, we are going to succeed. And again, that sounds a sort of a very arrogant statement to make, but the market needs innovation, and the market is crying desperately for innovation and competition within the primary business. Now, we've succeeded, we think, in the secondary trading. Now we want to make certain that we are going to succeed in the primary business, and that transforms Aquis.
Very interesting and exciting ideas, obviously, in terms of how you're going to try and make these new listings work. So therefore, you've got a segmentation that's going to allow you to go down to what's the kind of smallest companies that you're likely to see listing under the segmented model?
Well, we've been asked a lot about SPACs, special purpose acquisition companies, and one of the things we've got, we will allow SPACs, but we will definitely, again, different to that of the AIM market or the standard listing, is that we will be interviewing people. We will want to know, what is the entrepreneur looking to do? What is the strategy? You can't just come here with your £750,000 and set up a company without actually having a fully fledged business model and corporate advisor to sponsor you. But we do want to build, one of the fundamental differences between us and we think any other exchange is we want to build a relationship between the issuer and also the company, the corporate advisor and the exchange. Now that's very different. I mean, the 14th of June 2 years ago, when we floated our company, was one of the best days. I went to the London Stock Exchange. I was invited to open the market. I pushed the button. The market opened. Given some champagne. Met lots of dignitaries. Shook lots of hands. It was a wonderful day. But the mistake that I think that I learned afterwards is it was actually a leaving party, not a welcome party. Because although we were quoted on the AIM market, there is no relationship between you, the issuer, and the exchange. You have to deal through the nomad structure. And that means you enter a series of Chinese type whispers. And that is not an effective way. The exchange should be involved working with the company in order for them to help them grow. And I think that's one of the things that's going to make us different. And there's lots of other things. I mean, people can go out and have a look at our rules. Where actually the rules are, the new rules were set out yesterday, I think, actually sent out to people. More than happy to go on our website and have a look at the rules that we've got for the different markets. We did a consultation back in May. We've had a huge response from the industry. And I think for a company of our size to get the number of responses from the stakeholders, be they regulators, banks, brokers, advisors, etc., lawyers, accountants, I think says something about how the market needs to change. But more importantly, for when you have that changes, they want to change. And as we said before, if people don't want change, it's very hard to affect. But once you can show people the benefits, then you can actually have it. And I think we will succeed here.
Absolutely fascinating altogether. We've got a question coming up in 1 minute, but ladies and gentlemen, just to let you know, we've got under 20 minutes to go. If you'd like to ask a question of our guest this evening, Alasdair Haynes, the boss of Aquis, a fascinating dynamic exchange group building, reshaping the equity market trading business across Europe. Good friend of the show, previous guest. We have a question from Martin Watkins. Alasdair, how would you optimize the post-trade operation of the stock market without losing the Aquis trading cost savings you mentioned earlier?
Well, Martin, hi, nice to see you, or not quite see you, but nice to hear from you. Look, post-trade is absolutely essential. And I think what we have to do here is we have interoperability between the three clearing houses that we use. So we're really much at the front end. But our objective is to be one of the world's leading exchange services group. So we need to tackle at some point in time what is going to happen at the post-trade. Now, there's many people talking about distributed ledger technology. Is that the way forward? Can we get to T+0 without distributed ledger technology? How can we reduce cost savings? And what, funnily enough, I will tell a secret now that I've actually probably never told anybody, but one of the things I was thinking about doing prior to setting up Aquis was to have a direct exchange for the asset management community. And one of the things I advised at that point to the asset managers was to create a CCP for the asset managers, because that actually does disintermediate the industry. Now, that actually couldn't work today, and it can't work today for many different vested interests. But it was very well received by the interested parties from the asset management community, but they just weren't able to give up their settlement process. Now, post-trade does need changing. I had great hopes that within MiFIR we would see some of these things and some of the other rules and regulations that have come in. But I think it is a question of watch this space, because I think as technology progresses, we have every opportunity of seeing the cost savings through post-trade. And we're looking at even closer within the Aquis Stock Exchange. And the reason behind that, of course, is the settlement for small caps has been a very arduous and difficult process and a very costly process, and is one of the reasons I believe that we have not seen as much growth in turnover what you would like to see in the small cap industry, because costs are not coming down to the level. If you remember what I said earlier, this dream about you having your smartphone, picking it up, being able to trade for anywhere in the world for £1 or £2 a month or something, then you have to sort out the settlement side. I do believe in distributed ledger technology, but I sadly will say I think we are some way away from it happening in the equities market. And the reason being is that in order for it to happen, you have to get everybody aligned at the same time. And sadly, I think that is an impossible task, and it could only happen. You can only get people in the equities market to work at the same time if that is stated by the regulator, and I don't see the regulator ever doing that. So I think distributed ledger technology will come in with different asset classes before it comes in, and they'll come in with the newer asset classes like the digitalized assets before they come into the equity space.
Very interesting question. Thank you very much, Martin Watkins. Fascinating answer once again, Alasdair. So one of the things, obviously, it's been interesting in this theme throughout the course of today is the fact that you are an active entrepreneur in the exchange industry, and there are not that many people who can be described as entrepreneurial exchange executives. Do you have any advice, hints, or tips for anybody out there who's looking to build a new market in whatever asset class it may be?
Well, funny enough, I probably can give a couple of tips. I think that the very first tip is don't wait until you're in your 50s to do it, which is what I did. I've learned now and really regret, and I did some wonderfully fun things beforehand with Chi-X and with ITG and the various banks I worked in and stuff like that. I thoroughly enjoyed my career the whole time. But I really do wish I'd done this earlier because, I think the exciting thing about the entrepreneur is I look at myself now, I am 60, I am hugely excited, huge energy for it, huge passion for it. And I think the second thing is about passion. If you want to do something, and people sort of laugh at me and sort of go you can't be serious about it, but it's not about the money. I think if you're an entrepreneur and you want to come in and get rich, as most people try and do, and they think as being an entrepreneur is the way to making gazillions. For me, it never has been. And for the people I've known in other industries and other businesses, it's the passion that counts. I want on the sort of my tombstone, my epitaph to be, he changed a business so that many people benefited. Now, if I benefit in that outcome, great. And fantastic, well done. But it's not the reason for doing it. And if money becomes the reason for doing something, you'll fail. And I'm absolutely convinced you'll fail. The other thing is, whatever you are as an entrepreneur, you will struggle. We've had the days, I remember the very early days of Aquis where I couldn't raise money and I had to go out there. I financed some of it myself, obviously, to begin with, and then I was looking to raise money. And I do remember when there were 7 of us, sitting in a small room somewhere which we'd borrowed off somebody and coming in on the Monday, having had a sleepless weekend, saying, I can't afford to pay you. I'm sorry, we've just run out of money. And I will never forget that moment as long as I live, because all 6 of them looked at me and said, I thought you had something important to say. Now just shut up and get on with it and pay us when you can. And then I knew what an incredibly strong team and driven team it was. And needless to say, a couple of weeks later, we did get the money in and everything went. But it is a terrifying moment when you have to look at people you really care about and realize you can't actually pay them, and that's the end of the road. And I think one of the things that every entrepreneur has is, you look at the edge of the cliff and you try and find out ways, and you'll do anything, absolutely anything legal, obviously that is, to make certain that you succeed. And I think it's that drive, that passion, and that youth, maybe, that is required. But if you've got it, my God, is this a fun thing to do. I'm enjoying my life more than I've ever enjoyed it before.
Fascinating altogether. And you mentioned, obviously, the fact that the struggle to try and get backing for these things. I think in one sense, there's that incredible trope in the world of exchanges that all the big exchanges are buying each other and therefore they're all merging. And I mean, in my own diagram of the pyramid of exchanges, the one thing which excites me is we see more and new exchanges being formed every day, such as your own and many other ventures. Yet, we still seem to have a funding hurdle at the moment. There are very few people out there who want to invest in new exchanges.
I think that the UK in particular has been pretty poor. I think it's changing. I genuinely do think it's changing. And it's one of the reasons I'm so passionate about the Aquis Stock Exchange. We can't be first stage funding, but we can be early stage funding for companies, because, we do have this belief of companies start small and they grow and they mature. The great companies of tomorrow are 1 million, 5 million pound companies today, and they found their funding early from friends and family or from crowdfunding or whatever, and eventually they get there. I think the most disappointing thing for me is, we struggled with venture capital. I learnt an enormous amount about venture capital. I thought it was capital that was to be put into new ventures, and soon learned that actually it's only really, or certainly the people we spoke to, was as we were nearing profit. You can't believe how many people suddenly approached and said, we want to help you. But, when you're nearing profit is not the time that you actually need the funding. You need it at very, very early stage. And I think that is where the angel investment is so important. The best thing the government has ever done, I think, is the EIS schemes. The SEIS and EIS schemes helped us enormously. As a tech company, we were able to raise money. It was tax efficient for our investors. And I'm delighted to say we've made our early investors a very, very good return through the SEIS and the EIS schemes. And I think they are great schemes. I strongly support that. I think it would be a tragedy if they get removed, because it is the way that entrepreneurs can seek early funding through wealthier people who will pay a higher margin of tax, who can actually help fund these businesses. And it's if they get it right, it's a great return for the investor.
Fascinating altogether, those SEIS and EIS schemes and so on as being an early stage backing element. And you mentioned technology. You're a technology company building subscriptions and so on, but in fact your technology arm has itself spun out into being rather successful.
Absolutely right. I mean, we're one company, three businesses, multiple products, and we have the Aquis Exchange, which is the original subscription model for the top 1,700 stocks. We have the Aquis Stock Exchange, which is the primary markets business, and we have Aquis Technologies. And there's a lovely sort of irony there is we built this technology ourselves. We realized then that we had something that was really, really efficient, really effective, very cost effective to run. One of the big problems that I think people have, many exchanges, many startup exchanges, is they have to pay incredibly high prices for, efficient technology. And we've been able to cut that cost and make it incredibly efficient. So, we are the suppliers of technology to A2X, which is the first ever competitor to the Johannesburg Stock Exchange. We supply cryptocurrency exchanges. We supply bond exchanges. We supply a business that's set up within Lloyd's of London, the first ever electronic insurance market, and we supply the technology there. We supply surveillance technology. We've got incredible, investment bank names, high frequency trading names, where we are suppliers of technology. So I think we have world-class technology. And the great thing about the exchange business is really it's become a sort of showroom for what we can achieve in our technology, which is why that is now growing. And in fact, we spent money last year. We told our investors we were going to invest more in that area, because we do believe that we can significantly grow technology sales.
Excellent. And that actually brings us to a brilliant question coming in once again from Martin Watkins, the ultimate eminence grise of the Exchange Invest 1000 listing, no less. Alasdair, what advice would you give to legislators and regulators in order to further promote financial market innovation and technology?
Well, Martin, I think I can answer that almost in one word, which is proportionality. The problem I have with regulation today is it doesn't seem to be proportional, and that we end up with this one rule fits all, which is just not right. And when companies start, they need a different method, a different standard, in order to get to the second stage. And as long as, and I found this with asking investors, nobody cares so much about the standards as long as there is transparency and people understand what is in that standard. So in other words, if we look at the access market and the apex markets, the advice that we would give to any regulator or legislator is proportionality and the risk that people are prepared to take. This is why we feel corporate governance is the most important part of any company. And we insist that companies go into our apex market, which is the higher of the growth markets, have to sign up to a corporate governance code. Because if they do that, they're forcing transparency onto all their financials, all their directors, all the things that you require. Good corporate governance should be an asset to a company and not a cost, not a hindrance. And I think the advice we give there is make these things proportional so that you don't kill new companies that simply cannot afford to pay the prices that sometimes regulators are setting as a standard, and allow the market to know that maybe they're in a provisional stage before they get to their secondary stage of regulation, which allows people to assess the risks they're willing to take. So that would be my advice, is make certain that things are proportional, because I don't like a one size fits all.
One size does not fit all. Proportionality, that's a great answer altogether, and indeed echoed by Martin Watkins himself, saying it's a great answer. Thank you very much, Martin Watkins. Thank you also to Alex Wilkinson for your questions this evening. So we're into the last few minutes of our conversation. It's been really, really interesting to talk to you, Alasdair. I'm just curious, I mean, how do you see the world, looking beyond just Aquis, how do you see the world of exchanges, the world of markets per se, developing at the moment?
Well, the world of exchanges seems to want to change themselves into data businesses. If we look at the London Stock Exchange and Refinitiv deals, we look at the consolidation that's going on with Euronext and Borsa Italiana and Swiss and the Spanish exchanges, etc. So clearly we're seeing a period of consolidation, and we're seeing a period of trying to make money out of different things to what I would say traditional exchanges used to make money out of. I think that will change. I think that will change, because I think we have to go back to basics of what an exchange is. And I think, really understanding what is the purpose behind a stock exchange. And I think that is what we want to move to. And I think that's to our advantage, because as other people are looking at either worried about being taken over or looking at trying to consolidate, or they're moving into a data industry to compete with other businesses outside of the exchange industry, that gives us a perfect chance to move back into the space of what things should be for an exchange, which is, how do we create liquidity? How do we get more liquidity? How do you actually get companies to issue? How do you get the right proportionality? How do we get the right investor community? How do you get the right connectivity? And go back to the basics of what markets are all about. And that's how I think things will progress. And I hope, that is what we see. And competition is a healthy thing. It's, we are a pain in the neck for many people because we're competing. And I'm sure other people will come in and be a pain in the neck for us by competing. But that's good. Because without competition, and we've seen this so clearly in the primary market, without competition, you don't get innovation. And innovation comes because you have to innovate, because people are starting to compete. So the best thing that could happen to the AIM market or any other growth market in Europe is, I believe, competition and people like us coming in. So I hope to see more people. The barrier to entry is very high, but I encourage people who want to establish businesses, they should go out there and do it.
Ladies and gentlemen, we reached that point in our discussion where we could have been spending the evening discussing how, for instance, tourism numbers in Hong Kong are down 99.7% year on year. But we chose optimism, to look forward, to look towards an exciting and interesting worldview. And I'm delighted today to have somebody who's easily as loquacious as myself and as passionate about the exchange business. Alasdair Haynes, you are a true revolutionary. It has been a joy to be able to talk to you today on the show. It's fascinating when you say that you're looking at, three basic themes: and competition, back to basics, and the proportionality of regulation. But your subscription changing of behavior is a fascinating maneuver. And after 6 years of the operation of your exchange, we're at the point where you've reached an amazing 5% of the total amount of equities that are being executed within the European sphere across those 14 markets that you cover. You're in a position where you've got 21% of the liquidity, which certainly suggests to me that there is a considerable upside once the smart order routers realize just what is smart for them. And more importantly, you're talking about delivering a 15 to 20 million pound saving for the major investment banks and brokers each, while there's £1 billion worth of value on the table for investors to share, which could help everybody's pension in the future. Now, that sounds to me like a fascinating opportunity with markets, with innovation, with the different spheres of your business, providing technology, as you mentioned, as far afield as South Africa, as well as across your own proprietary businesses in the European Union. You've got this wonderful and interesting subscription model with the Aquis Exchange, and indeed also now you've got the Aquis Growth Market, where you've given us some fascinating new opportunities, including that very, very simple core opportunity, building a relationship with your exchanges. Ladies and gentlemen, my name is Patrick L. Young. It has been a joy this evening to be building on the long-standing relationship with Alasdair Haynes over a glass of wine. He remains a fascinating entrepreneurial individual, and cheers to you too, Alasdair. Enjoying a glass of red wine in France, how much more appropriate a piece of, well, some might call it cultural interaction that you can possibly imagine. Ladies and gentlemen, I'm going to leave you with one thought this evening. In these COVID times, we're in a situation where in many parts of the world, you can only meet in a group of 6. Nonetheless, if you happen to be, sadly enough, attending a funeral, you can gather in groups often of 30 or more people. To that end, we're going to see soon one of the great American festivals, and therefore on the 26th of November, I would like to invite you all to a funeral for my turkey. That way round, we should be able to get together a good, sensible, wholehearted number of people. And of course, the good news is I don't even know what the name of my dead turkey that we're going to mourn is going to be, but I'll be able to pick it up, duly embalmed, stuffed, maybe embalmed, for its cemetery ritual at the end of November, earlier from the butcher. Lateral thinking like that is the sort of stuff that you can see every day in action at the Aquis Exchange. Thank you. If you want to read more, don't forget to check in with Exchange Invest. We will offer you a 1-month free subscription to learn about the business of bourses so you can keep up with the leading exchanges in the field, such as, of course, Aquis and entrepreneurs like Alasdair Haynes. Alasdair Haynes, it's been a pleasure. This is the end of IPO-VID 010. Next week, we're going to take a brief hiatus because, of course, everybody will be busily getting the steam up in order to count their votes in the American presidential election. Thank you very much once again, Alasdair. Thank you to the production team. Thank you to Belinda for bringing this all together from the Aquis side. My name is Patrick L. Young, wishing you a great week in markets. We'll be back soon with IPO-VID.